Welcome, everybody. I'm Jennifer Cunningham, the AVP for Alumni Relations at Lehigh. I'm glad that you could join us today for this really important topic. I'm very excited to hear from our guest today. Seth Finkel is class of '80, and he is a managing director at Neuberger Berman. He's been there the last 20 years. He's also a current board member at the Lehigh Center for Financial Services. So he's going to talk to us today about some of our big concerns. He's going to give us a 5 to 10 minute overview of what he does and what he's seeing in the industry. And then we will open it up to your questions. And the way we will take those questions is through the chat box. We have almost 100 people on the line. So you can imagine if we did audio, it would be a little unwieldy. So we're going to use the chat box today. You can find the chat box at the bottom of your screen. Just click on the icon that says chat and you'll see a box come up, and there is a message that says type message here. You can choose to just send it to the panelist, which is me and Seth, or you can choose all panelists plus all the attendees in case you wanted everybody to see your message. And then I will read the questions aloud to Seth to allow him to focus on the responses. So let's get going. Seth.
Thanks, Jennifer. Thanks, Lehigh, for giving me the opportunity to talk to everybody. And thank you, everyone, for taking time out of your day to join us. So the topic is focused on what I'm hearing from clients, what we're doing for our clients in terms of responding to their concerns. And the first concern that we started hearing increasingly around the middle of February, end of February, and significantly into March was the obvious question: should I go to cash? Should I sell all my stocks? Should I sell all my bonds? And the answer to that question was mostly no, but in some cases it was yes. The question is really driven by behavioral finance, and John Nersessian, a fraternity brother of mine from Lehigh, a class member of mine, who's head of advisor education at PIMCO, has done a lot of work on this area. And I read a piece by him, and he did a great job of talking about the two major issues which can work to be the client or investor's worst enemy, and that's risk aversion and recency bias. And risk aversion talks about how the pain of losing money is much stronger than the enjoyment of making money. And that causes people sometimes to have their emotions override what makes sense. Recency bias talks about how investors typically invest not by what they should be looking at going forward, but what's happened recently in the past. It's almost as if when you drive your car down the highway, instead of looking in the front toward the front of the road, the front of the car, you're driving forward by looking in the rearview mirror, and that doesn't make any sense either. So I found in my 30 years in this business that one of the most valuable roles I can play is preventing clients from being their own worst enemy and doing things that are based on emotions as opposed to the facts. So when a client asks me, should I sell everything? The first question I respond with is, well, tell me about your risk tolerance and your investment objectives. Have those changed? If they haven't changed since the way they were back when we started working together, back when we reinforced those, maybe as recently as 2 or 3 months ago, I wouldn't make any changes in your portfolio only because of what's happening in the current environment. The reason being that we build portfolios based on 3 to 5 year cycles or more. And we believe that a type of drop in the market, take equities, for example, of 25 to 50%, has historically occurred on average about once every 8 to 15 years. So we build portfolios understanding that's possible, if not likely, at some point during a client relationship and at some point during the cycle that we're investing in, and we build portfolios based on that. It doesn't mean that we knew there was a pandemic coming, because obviously that part of it is unprecedented. It didn't know that we knew there were going to be lockdowns throughout most of the country and everybody would be working from home except for essential services. We didn't know that was happening, but we do build portfolios and are prepared for market drops of the type that we've seen. So if a client's risk tolerance and objectives haven't changed, my guidance and my team's guidance to our clients was, no, don't make any changes at the asset allocation level. We don't need to make any changes in the strategies that we're using. Just because we're not making any changes of asset allocation or strategies, though, doesn't mean that we're not making changes at the portfolio level. So our managers, our portfolio managers, have been making changes. More defensive positions, selling the positions that were more prone to damage as a result of what's happening in the changing environment, and taking opportunities where they exist for companies that may have been oversold. At the bottom line, the most fundamental basic principle of what a stock is ownership interest in a business. And if that business continues over the intermediate to long term of making money, generating cash flow, having revenue, that business will be worth more in the future. That doesn't mean it's going to be that way every 6 months, every year, but over the long term, eventually that value will be recognized. So we saw opportunities where companies were selling at 20, 30, 40% lower than they had been selling at only 2 months earlier. And the businesses weren't down that much in terms of the value of those businesses. So in most cases, my answer to clients was, no, we're not going to change anything at the higher level, but we are making changes and we are being responsive at the portfolio level. For some clients, though, my answer was yes, we should make changes. And those were generally in two categories. One was where clients would tell me, or I would get the sense, and being in this business as long as I have, it's taken a while to understand the nuances of what clients are saying, and it's more difficult when you're not doing that face-to-face. In some cases, it was a Zoom call. In other cases, it's clients that I know well, and I can tell based on the words they used, based on the tone of their language. But in some cases, they're losing sleep at night. They're not comfortable with the way their portfolios are situated. The qualitative part of what we do is much more important than the quantitative part. What I mean by that is clients have to have peace of mind. They have to be comfortable with what their investments are doing, and they have to be comfortable with us and trust us in terms of how we're managing their assets. So in cases where clients had some discomfort, in very, very few cases, we went completely cash when I was convinced and I was confident that that was the right thing for the client. In more cases, but not most of my clients, but in more cases, if we had cash in the portfolios because it wasn't fully invested, we would take the cash out of the portfolio manager's hands and have that sit in a money market fund, because at least that cash was then available for them to buffer the market volatility, to be available for them if they needed to increase the cash that they had on the sidelines outside of their accounts with us. So that was very helpful in those cases. And it was easy to do because the cash was already there. We didn't have to sell anything, which in taxable portfolios could realize gains, even though the market had gone down tremendously from the end of February through most of March. It avoided the gains that were caused by the other clients who liquidated portfolios on the direction that they gave us. So in those cases, in that case, selling made sense, or moving cash aside made sense. The other case where it made sense was particularly in this environment. We have many clients whose compensation income was either down dramatically or they knew it was going to go down dramatically. Clients who may have owned their own businesses who were shut, so their revenue stream was down. So in a lot of cases where it was appropriate, we talked to clients about their cash flow needs, and in some cases raised 6 months of cash, a year of cash. In extreme cases, we raised more than that to give clients the ability to sleep at night, see the cash on the sidelines, know they can access that for 6 months to a year and a half to get through what they thought would be a very difficult time in their businesses. So that was the main question that came up. That question started to phase out a little bit. But then, interestingly, just yesterday, one of my clients asked me that question again, and we had this conversation with them. The other question, which has popped up, has really been on the other end of the spectrum. It happened early on in this chaotic market. So it started happening when the market started to decline dramatically, and then it increased as the market started rising. And that question was, are there opportunities that we should be taking advantage of? So I went into the discussion that I had, that I mentioned earlier about the fact that we are making changes at the portfolio level, but outside of the strategies that we're using and changes in asset allocation, there were some opportunities that I spoke to clients about. Some of them were actually not directly related to investments, but as part of our wealth management practice, we do get involved in some of the broader wealth management aspects of clients' assets. We're not replacing the client's tax advisor. We're not replacing the client's estate planning attorney. We're not replacing their insurance agent, but we complement and enhance what they're doing with those advisors, or can work with clients on broader concepts that are part of wealth management. So some of the things we started talking to clients about were, if there were, and this one is actually closely related to investments themselves, but in some cases we had held off, or clients had held off on assets that they controlled themselves on selling securities, stocks, bonds, because of the gains that were embedded in those portfolios or those individual securities, and they weren't taking advantage of strategies that we recommended or that they wanted to do on their own because of the gains. They didn't want to pay the taxes, and that's understandable. We always look at what the after-tax benefits are of what we're doing with clients to help them. So now, all of a sudden, fast forward to end February, middle of March, end of March, a lot of those tax gains became much less significant. In some cases, they were wiped out completely, and in some cases, there were actually losses. So that allowed us to free up some of those assets to better deploy them in a way that made more sense for the client. Additional non-investment related aspects that we talk to clients about and continue to do so are Roth IRAs. This conversation is we don't have the time to discuss the full scope of what a Roth IRA is. Suffice it to say, as many of you know, it's a more tax advantageous way of investing in a retirement plan. There are tax costs, though, to do what's known as a Roth conversion, which is taking a current IRA that's not a Roth and converting it to a Roth. The taxes that are due are based on the income tax rate for the individual owner of the IRA and the value of the assets. So what's happened since the beginning of this year is clients who were thinking about a Roth but postponed it or deferred it for tax reasons, now if their income tax rate for this year is going to be lower because of their compensation or their business income, and or the assets in the IRA are lower, a Roth IRA conversion is more palatable given the tax consequences of doing so. There are also some more sophisticated estate planning and gift planning concepts, which again, we don't have time to go into them, but I encourage you to talk to your tax advisors, whether it be accountants, CPAs, income tax advisors, or estate planning advisors. But along with lower values, most importantly, the interest rate environment is so ridiculously low that the AFR, applicable federal rate, which is an interest rate that's imposed or mandated by the government for use in certain gift and estate planning strategies, is so low that certain concepts, estate planning and gift planning concepts, like grantor retained annuity trusts, charitable lead trusts, intra-family loans, things like that are much more advantageous because of the embedded interest rate. I'm going to stop there, I think, because that's about 8 minutes, 10 minutes or so, and I'll turn it over to Jennifer to ask some questions.
Great. Yeah, we've got a question from John. Thoughts about REITs in the 5-year horizon, real estate investment trusts in the 5-year horizon.
So REITs are really an interesting area. We're kind of neutral on them right now, meaning we're not against them, we're not for them outside of what the normal use of them would be. REITs come in many different flavors. There are residential REITs, there are apartment building REITs, there's commercial REITs. Any REIT that has rent embedded in it, where you rent the property out and then the rent gets passed through. Obviously, this is an environment where rent is a little dicey in terms of cash flow. REITs are great because of the interest rates that are received, and we use them as parts of our portfolios. In a low interest rate environment, obviously a higher interest rate is something that's worthwhile for clients, but we're fairly neutral on them right now.
Okay. Barbara wants to know, what's the average percentage drop in IRA portfolio worth for this period of COVID-19? Do you know?
So the average drop of an IRA really depends on how the investments were invested. I can give you some numbers, and it actually raises an interesting point. I can give you some numbers for the market so that the average large cap stock in the large capitalized stock in the U.S. as measured by the S&P 500 index was down about 11% through year to date through yesterday. But with the market being up today, it's probably down around 10% or so. Interestingly, though, large cap growth stocks that are more oriented toward growth and earnings, and that's why you're buying them as opposed to the current value of the business, gets into a discussion of value versus growth. But large cap growth stocks are, with today's results, depending on how it ends up today, are pretty close to where they started. The NASDAQ index, which is very heavily weighted with technology stocks, is fairly close to where it started the year, and at one point today, I think was even over where it started the year. So there's been a very big divergence, and that actually creates an opportunity that I should have probably mentioned before when talking about opportunities that we've been talking to our clients about. Relative valuations, meaning how high the stocks are relative to the underlying value of the businesses has been very divergent. So if you look at small cap stocks or MLPs, master limited partnerships, they've mostly underperformed the larger cap stocks, the blue chip type stocks, going back in some cases, in MLP's case, all the way back to the beginning of 2017, in small cap stocks, smaller companies in 2018, 2019, and year to date this year. Small cap stocks on average are still probably down more than 20%, as opposed to the large cap stocks, which are down around 10%, and large cap growth stocks, which aren't down at all. So from a relative valuation perspective, there are opportunities that are more appropriate, but small caps, small companies are going to find it tougher coming out of this economic environment. The MLPs, which are mostly pipelines, even though the oil prices shouldn't dictate the value of a pipeline, that's where the pipelines have been trading. So the MLPs are not for the faint of heart. Small caps are definitely something that is a longer term view, but those are the ones that have been out of favor, and value stocks as opposed to growth stocks. And then the last thing I'll say on this, and allow Jennifer to ask another question, is that we really are favoring active more than passive, particularly in this environment, meaning the ability to have a portfolio manager or a mutual fund manager buy stocks, buy bonds that aren't just the index, just aren't the benchmark. For the last 10 years, buying the benchmark has worked fabulously well. We think coming out of this environment in particular, active management, being able to pick the winners and avoid the losers is going to be very important.
Great. There's a couple questions in here about international. So Kirk says, it makes sense to invest in stocks at this point since they're more affordable. How would you allocate your stock investing between domestic and international? And then John has a specific question, your view on the US versus the international equity and equity positions, 2-to-1 or other.
So international is really interesting. A well-diversified portfolio should definitely have some participation in non-US opportunities. The fact of the matter is that many US companies, particularly the larger ones, have significant portions of their revenue and profits coming from outside the US. More recently, meaning over the last few years, international stocks, non-US stocks, and US stocks have acted in sympathy with each other. You see that all the time when if you turn on CNBC in the morning, you'll see them report on what happened overseas, and you see the US stock market futures acting pretty similarly. Having said that, for certain clients, we do allocate to non-US stocks, both developed and emerging markets. Developing meaning mostly Western Europe, Japan, North America. Emerging markets is almost everything else. So we do allocate to clients in appropriate circumstances, but many, if not most of my clients don't have a specific non-US allocation because we do get that participation through the US companies, and we get the regulatory environment protecting those companies, transparency, ability to do due diligence is much easier even in today's times. For clients where we do allocate to non-US stocks, we have been favoring US recently and going forward in the short term over non-US. It doesn't mean we wouldn't invest in them, but we would de-emphasize them relative to US stocks because of the economic issues of the soundness of the US economy, the ability that we think the US economy will have coming out of this. We actually expect that the US economy is going to show growth as early as the fourth quarter of this year, maybe as late as early next year. I'm going out on a limb because this is a recorded presentation, so people will be able to see how correct I was. But we think coming out of this, there's going to be such a pent-up demand. Doesn't mean people are going to get back to normal immediately. People are going to go get their car washed. They're going to go to have those medical procedures that they put off that weren't an emergency. They're going to be out and about. And we do think the pent-up demand, the extremely low interest rates, low energy prices, and effectively quantitative easing infinity, the governments around the world priming the economy, we think that is going to result in the U.S. economy at least having GDP growth in as early as the fourth quarter of this year.
Okay. Speaking of timelines, Doug's question is about after reviewing our asset allocation at the end of March, started to rebalance from bonds to stocks, invested about half of what he targeted, but with the big market recovery in April, I'm questioning whether I should continue. Should I finish what I've planned to do or wait until June to see what the asset allocation looks like in June?
That's a great question. I don't think we're going to retest the previous low that we saw on March 23rd, at least as represented by the S&P 500. I don't think we're going to retest that, but I'm pretty sure we're going to see significant volatility continue up and down. And if you think about what I said before about large cap growth stocks and the NASDAQ being pretty close to where they started the year, the economy is a lot more distressed than is showing up in some of the companies. We think some of the companies have gotten ahead of themselves. The market is not going to, we don't think it's going to be a V-shaped curve where, you know, a lot of the analysts are saying V would be down and then back up to the same point pretty quickly. I don't know whether it's going to be a U-shaped curve, which is a gradual move back upwards, or more like a Nike swoop, if you think about the Nike logo. I think those are probably, thanks, Jennifer. I think those are more likely. I don't think it's an L, which is down, and then it kind of stays at the lower levels. We obviously saw a bump up, and like I said, I don't think we're going to go back and retest the lows on March 23rd. But as quickly as it went down, it was quick to go back up, and I think some of that's justified because of the speed with which the market declined. But I do think we'll see lower points. I'm glad to hear that you did rebalance, because rebalancing is a good way to restore your long-term objective and risk tolerance asset allocation. That made a lot of sense. You benefited from that. If you had a plan that was in place and it was a gradual plan, I don't know that I would necessarily stop it. I think that investing gradually is much better than trying to time your re-entry. For those that have gone out completely, I wouldn't get all back in today, tomorrow, but I would definitely start to re-enter and get back in over time. I think being out of the market completely relative to your long-term objectives and risk tolerance, talk about a 5-year horizon, I wouldn't be completely out of stocks. I think market timing is a losing game. As I think it was Peter Lynch, the portfolio manager of Magellan Fund, back in the 70s and 80s, I guess it was, one of the most successful mutual fund managers, said about market timing, the only problem with market timing is getting the timing right. And what he meant by that is not only do you have to get out to avoid the downturn, but you have to get back in before the market starts its recovery. And human nature, having worked with clients who have gone to cash, human nature is such that when the market starts its ultimate, eventual, sustained recovery, the clients who have pulled their money out and gone to cash are the last ones that are going to be comfortable to invest in time, because when the market starts to move up, they typically will say, well, it's just going up temporarily. I'll wait until it goes back down before I get back in. And then they take too long to get back in.
So Anna's question, what would be a good portfolio allocation split for someone who's a year away from retirement?
I'm sorry, who is?
A question from Anna about a good portfolio
retirement
allocation split for someone who's a year away from retirement.
A year away.
Yeah.
So I think that every individual investor has an asset allocation that's right for them over the long term, and there's an appropriate level of equities. In some cases, that appropriate level is zero. But the portion that is in equities should be funds that you can commit for at least 3 to 5 years. So it doesn't mean that you can't make a change and you can't change your mind and you can't change back from equities or stocks back to bonds or fixed income. But from a year away in retirement, if that does mean that you're going to stop your compensation income, you're going to need to pull money from your portfolio, I would have at least a year or two's worth of cash flow in something that's not equities, whether that's cash or a money market fund, whether that's short and intermediate term investment grade or high quality bonds, or something that's not subject to the volatility and risk of the equities market. I would at least have some portion in bonds. I don't know what your asset allocation is now, but if one of the biggest mistakes I see clients make is because they're a year away from retirement, I'm not saying that you're doing this, but as clients near retirement, they think their asset allocation has to change. Well, the fact of the matter is, particularly with longevity in today's society, just because someone retires, it doesn't mean their investment horizon is still not 3 to 5 years, or more likely 10 years or 20 years. If someone retires at 65 years old, it's likely that their investment horizon for them and their family, who the investments are intended for, the investment horizon is probably 15 or 20 years. So I wouldn't go too light on stocks, but I would probably be, for someone, 1 year away from retirement, depending on risk tolerance and other cash flow that might come in from a pension. I would probably be somewhere between 40 and 75% in stocks, but it's very variable depending on the personal circumstances.
Right. I think all your answers end in "it depends" on personal circumstance, right? Ricardo's question, can you talk a little bit about your view of the impact to portfolios of inflation in the future that is surely coming with approximately $3 trillion of newly issued debt?
Absolutely correct. Inflation is coming. We should be concerned about it, but it's not our primary concern, nor should it be. Right now, we have to get through this economic cycle. That's where the focus should be. That's where the focus is by the government, fortunately, I think rightfully so. But if they take the opportunity when we come out of this to ignore inflation like they have recently during a positive, strong economic cycle, and they haven't done things to address deficit issues that will lead to inflation, then that does create a problem down the road. So we're actually already in some of our strategies positioning portfolios with stocks that will be more inflation resistant. So for example, companies that can raise prices on their goods or services and not lose business. So it's absolutely an excellent point to be aware of inflation. It's not something that we're terribly concerned with. It's not our primary focus in the short term, but it is a concern of ours that we're trying to resolve for the intermediate and long term.
And
bonds don't obviously equities are a better inflation protection than bonds, particularly in the interest rate environment we're in now. Under an inflationary environment, likely interest rates will rise, which causes bond values to drop. The longer term the bond, the more the drop, despite the fact that long-term bonds have done really well in the last 10 years in a declining interest rate environment. I wouldn't have a long-term bond in my portfolio right now because of the interest rate risk.
Kirk's question is about the election year and whether that will impact future volatility. Should this impact on how we allocate our assets now?
Very interesting. When we came into 2020, we thought this year the market was going to be more volatile than it had been in the past because of three things: Hong Kong protests, China-U.S. trade war, and the U.S. presidential election. We didn't reflect a pandemic and everybody working from home, as I said before. The U.S. presidential election is still something that's applicable. I'm not going to talk politics. Please, no one respond with the fact that Seth Finkel said something politically that he shouldn't have. I'm only talking from an economic perspective. But having Elizabeth Warren and Bernie Sanders not on the ballot are certainly a big improvement for the potential economy, just because of the obvious impact they would have on the economy and an increase in regulation. I think Joe Biden as a possible winner in the election and Donald Trump as the alternative, economically at least, the market has reacted more favorably to that and will continue to react more favorably to that. The polls certainly are going to show a better indication as we get closer to the election. And then once the election comes, we'll obviously have a better idea. Having a split in Congress and the presidential administration, meaning having Democrats or Republicans controlling one or both of the congressional sides and having a president on the other political party, actually has often acted as a positive check and balance, which is what it was intended to do. It acts as a positive check and balance for the markets as well, because it prevents, historically, it's prevented extreme actions from being taken, either progressive or conservative.
Well done. Has the market outrun, Al's question, has the market outrun the reality of where it should be based on the impending effects of the pandemic on small businesses? If so, is it time to bet against the market for the short term?
So I think the answer is yes and no. So yes, I do think the market has moved up a little quickly. As I mentioned before, if you look at the fact that the S&P 500 is up probably 25 to 30% from the low it hit on March 23rd, that's really quick. And there hasn't been a lot to justify that. We're still, yes, we're closer in some ways to antiviral therapies, possibly, hopefully a vaccine. So those improvements have certainly helped, but the market has reacted very, very quickly in ways that, and again, Russell 1000 Growth Index NASDAQ are pretty close to where they started the year. So those don't really reflect what's happening on the ground, other than the fact that a lot of the companies in those indices are companies that are still being used very dramatically in the current environment. Technology companies some of them are being used very heavily. So I do think the market's gotten a little ahead of itself. I wouldn't bet against it in the short term, even though I do, and this is where the yes and no comes in. Yes, I think the market's a little ahead of itself in the short term, but I think as long as an investor's objectives and risk tolerance for the intermediate to long term are to have equities, I would rather buy a company now or put money in the hands of a portfolio manager, let them make the decisions of what's right now, what's undervalued, realizing that it may not take hold for another year or 2 or 3, then bet against it and be wrong on that bet. You have much more to lose than you have to gain over your investment horizon.
Great. Well, thank you, Seth. We are at 1 o'clock. There are still a lot of questions in the chat box, but we will send those to you along with contact information for people if you would like to get in touch. Seth was just interviewed earlier this week by Barron's, and an article should be coming out this week or next, and we'll make sure that everyone on the call here gets a link to that, where Seth talks a lot more about his views on the market and investments. So thank you so much, Seth. This was fascinating. I know people learned a lot, and I did too. So thank you for your time, and thanks to everyone on the call, and have a good weekend.
Thank you, everybody.